Introduce our next speaker. Our next speaker is Reed Hastings. He is the CEO, co-founder of Netflix. You know him well. I'm going to bring him out. The story on Reed, come on out, is this. He had this idea in 1997, and the idea came to him this way. He said he had a big late fee for Apollo 13. It was 6 weeks late, is that right, Reed? And I owed the video store $40. I'd misplaced the cassette. It was all his fault. He said, I didn't want to tell my wife about it. And I said to myself, am I going to compromise the integrity of my marriage over a late fee? And on the way to the gym, he realized there must be a better way. So, Reed, thank you for being here. We appreciate it very, very much. Thank you.
Thank you. Do you realize they have free food out front?
There is free food out front. What have you been eating? Or you brought this?
Donuts.
Are you going to eat it while we're up here? Nice. So this is where I want to start. It's sort of an ironic sort of long-term, short-term issue, which is to say you started the company in 1997. We should say, by the way, you now have over 70 million subscribers around the world. But beyond that, you know, we talk about thinking long-term. One of the very interesting things that happened in your history at Netflix is in 2000, you tried to sell 49% of the company, from what I understand, to Blockbuster, which didn't take the deal. What happened, and what was the lesson in this sort of long-term, short-term debate from that?
So let's see, to take it back in '99, we had started our subscription service. We probably had about $5 million in revenue, Blockbuster's at $5 billion. And we recognized that if, by some chance, we're able to figure out the economics of rent DVDs by mail, because we were still negative gross margin at the time, but we thought with enough work we can get to positive gross margin and continue to climb, we're eventually going to have a fight with Blockbuster. And think how much bigger we could be if we were Blockbuster.com. And so we thought we should at least try to get them to be an investor and to give us the name Blockbuster.com, which they didn't then currently use. And the theory was, you know, we'll take advantage of it better than they would, and it'd be a good long-term play for both of us. So we were, you know, got points for creativity, but, you know, if you run a $5 billion company and then someone comes to you and says, yeah, we want your brand online, and you know, it was preposterous in hindsight, but we were kind of naive. And they were nice enough about it. They heard us out, and they firmly said, we're not going to give you the name for 49% of your company.
When we were backstage, you said, though, in terms of the long-term, short-term debate, that they were thinking too long-term. What did you mean?
Well, they were not going to sell away their future for 49% of something that was essentially worthless at the time and relative to their company. And so they were very focused on the long term. They need to keep this asset. And we were hoping that they would do this deal, which then we would have grown much faster, bigger, and avoided this enormous battle that we had over the next 8 years. But in hindsight, it was impossible to avoid. For us to succeed, we had to have that battle with them.
Right. Take us out, I don't know what you think of the long term in your business now, but take us out a decade from now. TV has totally transformed the way we access it, the way people here access it on mobile, we watch it on TV screens. We have cords, we have cord cutters. What does TV look like 10 years from now?
Sure. If you think about the fixed line telephone, it was a miracle. Took, you know, over 100 years to become as mature as it was 20 years ago. And then the mobile phone came in and really improved the experience. And since then, fixed line voice minutes have declined rapidly. Fixed line lines eventually started declining. But basically, the mobile phone was built on the infrastructure and the back end of the switching, you know, of the fixed line system. And in a similar way, linear TV pioneered many things, like what are the conventions for telling a story? How do you do an over-the-shoulder shot? How do you do a 4-camera sitcom? All these things that have been built up to a very high level of storycraft, so high that U.S. stories are popular around the world. But the problem with it is the consumption experience was limited to 8 o'clock on Thursday. And you could only watch it 8 o'clock on Thursday, which is a ridiculous system. It's like only being able to take phone calls at home. I mean, that's crazy. And so now there's a new modality which is on demand, happens to come over the internet. So we call it internet TV, that lets you watch anytime, lets you watch on any screen, lets you have constantly updated and improving user interfaces, personalization, all these benefits. And so that's what this revolution is basically internet TV. Building on the back of everything that's been built up on linear. But linear TV will decline. Viewing will decline just like voice minutes on fixed line declined. The number of subscribers will be relatively stable for a fairly long time because of TV everywhere, which is the notion that you get internet consumption by paying your $80 to Time Warner Cable. You get to experience all those networks.
So you don't think that gets upended anytime soon?
No, I think not. There's so much content in it. And TV everywhere, I know for many people in this room, they probably call it, TV never and nowhere and all these things. But when forced to act, they will improve. And then I think a lot of viewing will be essentially watch ESPN. This great internet app that will get better and better, and you get access to it by having an ESPN subscription, which comes through a cable set-top subscription.
Who loses?
Well, entertainment has shown an amazing capacity over the last 30, 40 years to just continue to expand as disposable income and time increase. So, for example, in video gaming, that's grown, to a $20, $30 billion industry, and it's not clear where that came from except more spending on entertainment. And I think that's what's happening, is internet is just getting layered on top of total spending.
So you don't think anybody gets crowded out in this as a result?
People will get crowded out if they don't do good shows. So if your content, if you get obsessed by other people and you don't focus on having great content, you can lose, just as you could in the current model. But no, I don't think it's a straight replacement cycle, because so much of the economics today around the shows are based on these TV everywhere models.
Right. John Landgraf of FX, said it over the summer. It's a conversation everyone's been having in the media world. He says there's simply too much television. There are now 400 scripted series that are expected to come out by 2016. What do you say?
He's wrong. There's not nearly enough, and we are trying to expand significantly. We have an incredible show, Master of None, coming out on Friday. Aziz Ansari's done an amazing job. It's some of the most interesting comedy, drama mix that you've ever seen. It's just an extraordinary 10-episode series on Friday, and we want to do many more of those. But
you don't think there's just too much? I mean, it feels as a consumer that there are now so many good shows on TV all the time that there's not enough time to actually watch them. And I assume that means they're going to be losers.
There's a lot more food than ever before. There's we have a lot of choice. But I think if you do great content, you're going to find viewers. And the bar is definitely rising. There's no question about it.
Given all the competition in your space right now, and when I think of competition, I'm talking about Amazon and Hulu and Showtime and HBO and everybody else who's in this space, is there a point at which you have saturated the market? Is there a number at which you say, okay, we've captured it, and it's impossible to grow that much bigger?
No, again, it comes back to entertainment spending. And entertainment spending has been increasing, faster than disposable income for decades. And I think as we come up with new experiences, when you look at virtual reality and how that's going to improve video gaming, you're just seeing continued investment in entertainment.
You're spending $6 billion a year on content?
Roughly. I think it's $5 billion for next year.
$5 billion for next year. And you're taking on debt to do that?
No, those are P&L numbers. The $5 billion is a P&L number. So,
but you borrowed about $1.5 billion recently?
Yes.
So when you think about having to borrow to expand,
yes.
At what point do you say, it's too much?
It's a long way off. Our debt to market cap ratio is very low compared to S&P 500. So we have a lot more debt capacity. And in general, Silicon Valley doesn't do much debt. And then, the culture is you look at what your peers are doing and they're not doing much debt. So there's an aberration of low debt compared to the rest of the economy. Right. And we look at it more compared to the general S&P 500, in which case, again, our debt to equity is very low.
Let me ask you about your shareholders. Do you think of your shareholders as long-term shareholders or short-term shareholders? And let me just read something that a shareholder who's not a fan said. This is David Einhorn. He said, in today's market, the best performing stocks are companies with exciting stories where accountability is in the distant future. Red ink is the new black. Is red ink the new black?
No, we're profitable, so it didn't apply to us. But, you know, depending on the day. So we had earnings a couple weeks ago, and I thought the numbers were very good. We were a little low on domestic and a little high on international, and so spot on global, and the stock traded down 10%. So I can say, okay, it's you know, short-termism, but really, I mean, for Netflix, we're running barely profitable. We're $1 billion negative free cash flow, and we've got a $50 billion market cap. So if that isn't a testament to long-term investing, I don't know what is. I mean, it's an incredible backing, and I think it just shows that long-term works, and that's why the big pension funds, the big investments do it, because it's differential advantage. But I'm not anti-short-term, because when I see high-volume short-term trading, I just think that the liquidity is very helpful. So I'm not sure, you know, people try to make money where they can, and many investors in this room and otherwise are differentially good at long term because it's different from the crowd. Right. The crowd's too short term.
But how much do you have to, as a result, though, in terms of incentivizing your employees and whatnot, have to actually focus on the short-term nature of the stock, even though you think your shareholders are long-term?
You're dead if you do that as management. If you start trying to manage the short-term stock price, you're chasing your tail. So you have to, the key in management is you got to have your stable, long-term, successful picture and motivate people, both employees, suppliers, investors, towards that picture. And there'll be uneven amounts of execution towards it, potentially doubts at times if it's achievable, but you can't get concerned. What you want to do with employees, and what we do, and I think everybody does, is just try to teach them that just because the market goes up or down 5 or 10 or 20% is not that correlated to the long term.
Right. I want to go back to TV just for 1 second, because we're talking about the competition in the marketplace. And I'm curious, one of the big decisions that came out recently was Hulu, which of course is owned by Disney and Fox and Comcast, decided that they are going to effectively allow Hulu to launch an ad-free product. When you see them do that, I assume you think that's great for your business to some degree, but do you think that they're going to eat their own lunch by doing that? It's going to cannibalize their own business because people are going to punt effectively on all the ad dollar?
No, Hulu's been a very successful competitor to us in growth of the market. Their big advantage is they have the major broadcast networks' current shows. So CBS, ABC, NBC's current shows, you know, day after, now commercial free. And that's because of the ownership structure. And so they have a unique proposition. You know, we have original content. They have the current shows day after. I would say, and I've said, that Hulu is much more the cord cutter's dream, because keeping you on cable and satellite is those new shows from the big broadcast networks. And so I'm a little surprised at the structure of it, but I think it's just because...
Surprised because you would think that it would cannibalize their business long term.
Yeah, if I was an owner of current cable networks, I would not be having Hulu be my cannibalizer. I would have it be abc.com as a tethered application. So you get to watch abc.com news shows if you're on cable versus on Hulu. So I think there's a strategy error on their part, but they're working through that. And no, the ad support just gives people multiple options. I mean, Hulu's doing that. Hulu's doing more personalization. We're learning from them. They're learning from us, from Amazon, from the BBC iPlayer. You know, the whole industry segments are learning from each other.
You mentioned sports earlier, and then you mentioned ABC, which got me thinking about ESPN. ESPN's, or Disney's stock rather, dropped somewhat precipitously over the summer because of concerns about sports and sports rights and whether they could remain as profitable in a cord-cutting world. What do you think is going to happen to ESPN?
I'm not a close follower. I mean, it depends a lot on what they paid for those contracts for the underlying content. But they have an incredible franchise, and sports is not something that we've spent any time on. You know, we're working really hard on getting more movies and more TV shows, and that's a plenty big enough prize for us.
Do you look at the economics of sports broadly, either both sports networks or, by the way, even teams, which depend on the carriage fee?
No, I don't really look at all those economics. I got so much to learn about the global movies and TV show picture. We really stay focused there.
So can you see a day where you would offer sports?
No, I don't see that.
But you do see a day where you offered news. You recently said you were going to get into
Looking
news
for a
business.
job again in public.
Touche.
We're doing Chelsea Handler is an amazing talk show host. She was on E! And we're bringing her on a Netflix show starting next year. And it's a talk show about entertainment. So it's pretty close to home. It's not really breaking news. It's creating news and doing interview pieces. And in a way, that's like, it's this sort of edgy, we're going to try and reinvent the format a little. It's something that Vice might think about because Vice is very good at those kinds of things. And that's where the confusion came in about this is something that's, like Vice in a brand sense, but not, Vice is really in the news business and we're not.
Do you ever see yourself doing live programming?
Well, again, Chelsea Handler is pretty live, so that we're not opposed to that. That's just different from big ticket sports.
But not big. But you don't ever see yourself doing an evening newscast or some other kind of news-oriented programming.
No, you don't want to invest in things that are dying.
Ooh. Ooh. Ah. Okay, new subject.
You're on demand. I mean, your viewers read you all the time, 24 hours, right? You're across that. But the newscast at 6 p.m., I mean, that thing's going away.
Let me ask you about the relationship that you have with so many of the other players. And I'm thinking of Apple TV, I'm thinking of Google, I'm thinking of Amazon. You have historically relied on their boxes, in some case, to distribute Netflix. So recently, I don't know if you saw, I'm sure you saw this news, Amazon stopped selling Apple TV and Google's Chromecast, the actual box. Do you see a day where you guys are in competition with each other so much where you can't get effectively distribution over those boxes?
Now, the internet proposition, when a company sells broadband access or has internet applications, it's pretty open access, is the underlying cultural assumption. So you've seen these tensions with Apple on the iPhone. When they block a certain app, they have to be, even them with all of their brand powers, very careful about what they block and don't block. And they wouldn't block, say, Google Maps because they want you to use Apple Maps. And why? Because that would be such a brand violation. It's not a legal thing, it's a brand violation. And so that is the general internet course of people being open to apps. And we've seen openness to apps. In Europe, most of the cable companies, Orange in France and Virgin, integrate us right on the set-top, integrate Netflix in a cable set-top. And then Suddenlink in the US does that.
What do you think Apple's going to do with Apple TV, for real?
Nobody knows. That's what the cool thing about Apple is they're really good at that whole secrets thing. And I learn more from reading, the New York Times than I do from any other source.
Let's talk about regulation. You successfully blocked, or were one of the many that sought to block Comcast from buying Time Warner Cable. When you think about distribution over the next 5 and 10 years, and you think about wireless, and you think about the connections between a DirecTV and AT&T, and Comcast recently may have gotten together now with Verizon, how do you see that all playing itself out, and do you see yourself trying to block those further? Is that good for your business, bad for your business, if ultimately you're going to need distribution?
Fundamentally, our societal interest and Netflix's interest is around as open and fast an internet as possible. And so that's the North Star, is trying to figure out what policies generate that. One view on internet is it should be fiber to the home, like a utility, like water, like sewage, like power. And the basic architecture is just not that suitable to a competitive framework. And yet we as a society are very much in love with competitive frameworks. And there's some hope that wireless will eventually be a competitive framework at high speed. But right now, the physics of that are extremely challenging. And so I think what we and other players are trying to sort through is, in the meantime, how do we get to really high speeds, great access, and open internet for them to be lots of competition on top of it? And that's our sole interest.
Do you ever see a day, by the way, where wireless takes over from cable? Meaning that the broadband speed is fast enough physically that people are getting the equivalent of TV by LTE? And does that pose an existential threat to the cable operators, which always were sort of thought as owning the railroads, if you will?
It's just a cost advantage. Right now, data costs on wireless you either have to double the bandwidth, you either have to get more spectrum or put more antennas in. And ultimately, you get to a situation like Wi-Fi in everybody's house. That's in some sense wireless, right? It's just, you know, you've extended it all the way to the home. And so it's a continuum. But no, I don't see an existential threat. I think the physics of wired fiber optic distribution are so phenomenal and so powerful that once you lay that, you know, it's like a highway. It's open for all.
I want to talk real quick, and then I want to open it up, talk about culture. Because one of the things that's so unique about your firm and your company is the culture. And thinking about the long term, I want to tell you about two things that they've done, one recent, one less recently. One, I was looking, you have an expense policy, apparently, at the company that's literally 5 words long, that literally just says, act in Netflix's best interests. That's it. What does that even mean?
Well, fundamentally, you learn the lessons of your past. In my first company in the 90s, was an innovative Unix software company. And every time there was a mistake, we put a process in place to make sure that mistake didn't happen again. And so we were tinkerers building up this perfect machine. And the problem is eventually the market shifts on you in some way, and all you've got is people who follow process and follow rules, and you don't have the DNA to change. And it's deceptive because it's actually super efficient until the market changes. And then in our case, it was C++ to Java, but you know, markets always change. And then if you don't have the DNA, and you basically are over-optimized for one ecosystem. So for Netflix, what we realized is we should be suboptimal in many cases because ultimately flexibility was more important than efficiency over the long term. In the short term, efficiency, you know, getting out error is the right. But if you look over the long term, you want to work towards flexibility. And one little aspect of being very flexible is that expense policy. Right. There's many other aspects that we have. But again, the North Star is if you're building for the long term, you need to tolerate some chaos and you need to have lots of creativity because markets do shift, new competitors arise, and you need to have enough DNA of that to be able to survive as opposed to what happens to many firms.
So you recently announced a new policy that created unlimited parental leave following the birth or adoption of a child. How did you get to that? And what was the thinking involved in that?
Sure. We've had unlimited vacation for 10 or 15 years. So it's really just, I know parenting is not a vacation, but you know, it's really just an extension, which is, okay, if we're going to have unlimited vacation, you know, why don't we have unlimited parental leave and give people permission? And what we find is a wide variety of things. People come back, both fathers and mothers, sometimes early, but they'll come back part-time. They'll come back after an extended period. What we're trying to do is earn loyalty and trust that they really care about Netflix in addition to caring about their family, and that they find successful ways to integrate it. Remember that most of the conversation is kind of sterile. It's about work-life balance, like you put a pound on this and this scale, you know, and it's one or the other. And in fact, for all of you and for all of our employees, it's really about work-life integration. It's about successful work-life integration. So you don't sit down at dinner, you know, with your husband and suddenly you're on your, you know, mobile phone all the time, right? You make certain rituals. And yet other times you do keep a flow. Late at night you get up and you're able to do some work, and because you really care about the firm. And that modern successful integration, we all are learning as a society how to do it and not have us become neurotic or controlled or overworked. And yet find those ways to integrate work and life. And so, again, that's all part of this, you know, trying to figure out what does a creative business do.
Is there peer pressure? Meaning, how long do people take on average vacation? Have you looked into this?
Well, since we don't track it now, remember we just started this a couple months ago. Yeah, there's a twin set of dangers on either side. One is that, you know, we say unlimited vacation or parental leave, but if you take it, your career is toast. And we want to make sure we do what we can internally, make sure that doesn't happen, lauding people, you know. And I take a lot of vacation, and I'm open about it internally to try to set a good example.
How much vacation?
Oh, 6 weeks a year.
Good for you.
And it's helpful. You know, it just as you would expect. You often do your best, you know, thinking. You know, you're off hiking in some mountain or something, right, and like you get a different perspective on something, or you're reading something that's not connected to work. You know, the other danger is that I don't know. So you could take your worst case. If somebody joins Netflix, and their wife is having a baby, and they take a year of paternal leave, and then another year, and in 6 years they've worked 3 months. I mean, you know, it's not going to happen, but you could. But again, coming back to the underlying thing, flexibility is more important than efficiency. Most of us are so wrapped around efficiency and management that we don't sufficiently value flexibility. And so we're willing to take some inefficiency narrowly and in edge cases to create an environment that's extremely flexible, because we think that outperforms in the long term.
Final question for you. In 2009, you wrote an op-ed in the New York Times where the title was "Please Raise My Taxes." And you said that a starting place for tax not shame would be creating a top federal marginal tax rate of 50% on all income above $1 million. How did that happen? What was your thinking about that, and what's happened since?
Well, the thinking 6 years ago is the same as today. And in my personal view, which is not a Netflix view, we are not coping well with the unequal rewards. If you're highly educated in the society, you do have incredible rewards. And a compensation above $1 million, I think you can give up 50% of it on a federal level, and to support the investment, as goes the rest of the op-ed, in better schools, better services, you know, giving people more opportunity. And you can argue, you know, schools are inefficient. That may be true, but we're working on that side of it in parallel. But the big surprising thing to me is if you look at how wage earners, because basically you're a wage earner, I'm a wage earner, we're labor, even though we're high-end labor. But really capital, the way super rich people make money, is taxed so much less. And that's this long-term capital gains thing. And what's incredible is that, you know, wage earners, high-end and low-end, you know, pay 40-something%, and yet, you know, it's 20-something% if you make money on capital. It's almost like it was designed by the capitalists.
There you go. Let's open it up for questions. I know there's a couple people in the audience that we'd like to get to. I see Rich Greenfield right over there. Rich. Wait for the mic if you could.
Hi, Rich Greenfield, BTIG. So, Reed, there's been a lot of talk from the industry, the broad media industry, many of whom are sitting in this room here, about how maybe selling content to Netflix or selling content to Amazon maybe wasn't such a good idea in hindsight, as it's kind of shifted consumer behavior. If we turn the tables around, if you were Jeff Bewkes or you were Rupert Murdoch and Andrew was questioning you, what would you be doing? How would you think about the right strategic decisions running a major content creator today?
Well, I would invest more in TV everywhere, and Jeff Bewkes pioneered that idea 7, maybe 8 years ago and has been trying to drive it. The challenge in the industry is very fragmented between the cable networks and the distributors, and so it's really tough to work well together to extend the ecosystem. And so we've always been most scared of TV everywhere as the fundamental threat. That is, you get all this incredible content that the ecosystem presents now on demand for your same $80 a month. And yet the inability of that ecosystem to execute on that for a variety of reasons has been troubling. Now, some of the independents, so Showtime, HBO, have done a much better job. You know, their business model is more straightforward because it's subscription. So they're leading the pack in terms of now getting out there and marketing to subscribe, you know, directly as a consumer. So that little niche has a protected, you know, system, but the big system has to figure out TV everywhere to get relevant for the internet.
Get another question. I see Matt Blank, my friend Matt Blank, CEO of Showtime. Full disclosure, we have a thing together, so.
A show together.
A show together, yes. Thank you.
Matt and I have a thing together, too. So
there you go.
Reed and I, you know, we use this term for years. We're called frenemies. But, Reed, I appreciated your comments on John Landgraf's statement about too much great TV, because we think there's a lot of great TV, but there's never too much great TV. But one of the things you've said is that, you know, you'd like to get to 40 original scripted shows a year and maybe even every week having a new show. And I think that'd be great to aspire to, but how do you maintain the quality? You know, we were at 6, we were at 8, we were at 10. We're pushing towards 12. We'd like to add 2 more really great full-bodied scripted hours or half hours every year if we can. And then the seasonal part of our business kind of gets diminished as we, start dealing more directly with consumers. But one of the things we worry about is how do you maintain the quality if you're a premium service, and we view you as a premium service like we're a premium service, and make sure that every show that somebody sees, somebody thinks that's worth paying for, whether they're watching it or not.
The thing on the internet is
billions will be, Andrew.
Thank you. When I look at our shows, we just had one come out this summer, Narcos. It's a very different kind of show. So it's an American company, Netflix, contracts with the oldest movie company in the world, a French company, Gaumont, to make a production in Bogota, Colombia, featuring Brazilian actors and directed by a Brazilian, 3/4 in Spanish, 1/4 in English, and it's hugely popular in Germany. Okay, so it's an so you go beyond the normal spectrum of, to get quality, and you really stretch to the things that you can do. And on demand and the internet gives you a lot of that power. When you've got incredible distribution, then you have to open up the front end of the funnel to have incredible producers around the world. So we're hopeful that we'll, over time, make a great Bollywood show, make a great anime show. And, it might not be that Bollywood show is for Matt Blank. It might be that, it's more segmented. But again, the internet lets you do that. So I think that's the key in that enablement. But as Matt knows, making these shows is very challenging, and I'm sure we will have issues over time. But for right now, I'll come back to my Master of None promotion. I think you guys will love it.
Okay. There you go. Reed Hastings, thank you very much for the conversation. Thank you for the